Friday, August 16th. In the media business, August is known as silly season. Maybe we buy Greenland and maybe we don't. In the land of financial markets, it's important to me to feel needed by my customers and by my client base, and once in a while there's a financial event going on which the media just have wrong and stay wrong, and only relatively old-timers or people who work in markets actually understand what's taking place. And so today here I am. Every customer is now waiting for what the Fed does in September, hanging their refinances and their purchases and their interest rates on what the Fed's going to do. The president is clearly focused on what the Fed might do. Even the financial media is deep in how far the Fed's going to cut and how fast. The real story underway, the latest tariff announcement, which is now 15 calendar days old, has triggered another cascade down in interest rates all over the world, which were already headed down. And first thing, don't wait for the Fed. The markets have already eased for the Fed. There's not really any reason for the Fed to cut its own interest rate and the overnight cost of money, because markets already have. And markets have not cut their rates, mortgage rates below 4. 30-year fixed-rate Fannie Mae loan yesterday briefly at 3.5, back up today, but not terribly far. There isn't any reason for the Fed to ease. What's it supposed to do? Following that trail, this week we had an inversion of 2-year T-note above 10-year T-note, which historically predicts a recession. Not necessarily tomorrow, but within the year ahead, maybe 6 months ahead. Not this time. No, not at all. Pay no attention to this noise. Inversions take place historically and predict recessions when the Fed has been engaged in a long inflation fight. The Fed can't know that it's won in real time. It always knows in the rearview mirror. And so an inversion results when the Fed is pushed up here and market people just perceive distress in the economy and begin to buy bonds, and fewer people apply. And so long-term rates fall, and it takes a while for the Fed to cut. We haven't been in one of those. The Fed has been normalizing the cost of money. It started 4 years ago and reached the stratospheric level of 2.5. That last move to 2.5 last winter didn't do any damage to anything. We hit a slow spot because of the shutdown, not because of the Fed. The Fed created the impression that it had more hiking to do, which took mortgage rates above 5, but the Fed clarified so fast that rates didn't stay high enough to do any harm. The Fed controls the cost and availability of credit. Credit today could not be more plentiful, unless you wanted stupid terms again. But nobody's having difficulty getting a loan who deserves a loan. There is no distress in credit. There's no sign of difficulty either being granted credit or making the payments on credit that we already have. What's the Fed supposed to do? It didn't create a problem by overshooting. The trade trouble and slowing economies overseas haven't created any distress here. There isn't even any reason for the Fed to preempt something that's not on the horizon. So leave all the Fed stuff aside. What's really going on, the actual distress outside the United States, we can tell that the drop in long-term rates here is foreign money coming here because the drops are happening at night in Asian and European markets when we're asleep. Also, the money is going to treasuries and not to mortgages. Mortgage rates are down a long ways, but frightened foreign money goes to treasuries, not to our stuff. So the spread between the two has widened. We know it's overseas trouble. What's the Fed have to do with that? Nothing. The deep trouble overseas involving trade. Mr. Trump, 15 days ago, kicked a wasp's nest and it's now stuck to his foot. But that's more likely a precipitating event than it is a root cause. The root cause of trouble is the last 20 years, both China and Germany have overplayed their hands as exporters. Both of them have behaved in predatory fashion. Both of them have behaved so badly, running huge trade surpluses and elbowing others out of the way in different ways but with the same result, that they have harmed the ability of everybody else to buy the stuff that they make. And that's a deep problem. Europe is not viable unless Germany begins to spend money and becomes an importer. And instead, it's running a huge trade surplus and a budget surplus. China has taken the place of the ugly American in spades. Its ego has triumphed over common sense. And it's walking all over the rest of the world. If you don't buy our stuff, we're going to make you buy our stuff. I hope that the Fed in September, in a roundabout way, of course does not pick a fight with the president, but in some roundabout way asks for help, says that the issues that we're dealing with globally, global trade, were not caused by central banks and are beyond the ability of central banks to fix them. On that note, have a nice summer weekend.